Wealthy and Wise is your guide to value investing, powered by Teaminvest.
A warm welcome to Wealthy and Wise, the show for investors who care more about staying wealthy than getting rich quick. Well, this week, we're tackling a question every investor is asking. What happens to companies and to value investing when interest rates are rising? Besa, Deda, chief economist at William Buck, joins that conversation. And in head-to-head, Andrew Coleman from Teaminvest and Michael Carmody from Centennial Asset Management put real companies to the test, asking a simple question: should a jump in rates change your tack when it comes to investing? And we'll answer a viewer question from Peter. So Peter, I do hope you're watching. First, let's add some value. So let's set the scene. What's in store for rates, and how will rates likely hit consumers and businesses and therefore investors? A very warm welcome to the program. Besa, Deda, who is chief economist at William Buck, and Andrew Coleman joining us from Teaminvest. Besa, just to get us started off the top, in your view, what sort of interest rate environment are we heading into in the next sort of 12 to 18 months?
Look, I think when we have a look at the underlying inflation environment and when we consider the upgrades that the Reserve Bank made to underlying inflation forecasts, we would expect that there's at least one more rate hike this year and possibly two more. We don't think it'll be a very aggressive cycle, but we also don't buy into the idea that they're one and done. We think that there's good reasons to expect more tightening, and I think households and businesses and investors need to brace for that tightening.
Are we already seeing some of this, I guess, expectation for further interest rate hikes flowing through to, say, consumer confidence?
Well, consumer confidence was out today, published by Melbourne Institute and Westpac, and there was a drop in consumer confidence. It wasn't as large as perhaps one would anticipate, given that we've just seen a very swift change from the Reserve Bank, from a rate cutting cycle that only ended in August to a rate hiking cycle. In fact, that break between drinks was the shortest since inflation targeting began in 33 years. But it does highlight how fragile consumer confidence is. And it is sitting below 100, which means there's more pessimists that outnumber the optimists in the economy.
So that, to me, Andrew, would sound like something that could be concerning for investors, because if consumers aren't feeling confident, if we've got a couple more rate hikes in the future, I mean, the bell is ringing for retail stocks, right?
Well, that actually depends. And I think that's the really interesting thing. And we'll talk about that a lot today when it comes to rising interest rates. I mean, obviously, overall, rising interest rates are aimed to have a dampening effect on the economy. That's the goal that the RBA is looking for. We're trying to rein in inflation and reduce aggregate demand. But remember that despite the fact that we tend to talk about the market as sectors, each sector is made up of companies with different consumers, different capital structures, different suppliers, and that those changes in interest rates or inflation will affect, therefore, those companies very differently. So whilst as a whole retail is unlikely to be a winner, that doesn't mean that individual retail stocks won't actually be a beneficiary, because their customers may be the type of people who end up with more money in their pocket with a rate rise, rather than, say, younger consumers who are likely to have it taken away.
Yeah. Okay. So that's consumers. How about businesses, business investment, business spending? I mean, how quick is that transmission to businesses in your view?
Look, I think the conditions are still really good for business investment. And I think one of the things that really stood out when the Reserve Bank published their fresh forecast was the upgrade to business investment in the near term, or at least when I looked at the numbers, that was one of the things that really stood out. Look, business confidence and business conditions are still reasonably robust. We have seen some upward pressure already in business borrowing rates, because swap rates have anticipated that a Reserve Bank rate hike was coming since late last year, and really those expectations have built up, and that's fed through to the swap rates, which then feed through the business borrowing rates. So if we have a look at interest rate markets right now, they are pricing in one more rate hike as a done deal, and about 50% chance of a third one. And so that's already reflected in the swap rates, and the longer they sort of stay around there, you see that flow through to business borrowing rates, and you see that flow through to fixed home rates as well.
So this shouldn't be any surprise for any competent sort of business management team that we are seeing these rate hikes coming through.
Well, there's a lot of volatility, there's a lot of uncertainty, and the RBA has demonstrated in the past that they're fairly cautious and they do like to move after they've seen the quarterly inflation report, although now there is that new monthly inflation series, after they've seen the labour market data, after they've seen the GDP data. So there's still a degree of variability, I would say. And then if you throw in the global economy, and we're still having whiplash there with announcements on the global front around geoeconomic and geopolitical risks, then I think there's still that volatility that business investors have to work through.
And when you are speaking with businesses, because I know that you're very much at the coalface of all of that, Besa, where do you see the most pressures coming through? Is it on costs? Is it on investment plans? Or, willingness to take risk at all?
So one of the things that comes through is finding labour that really matches what they're after. So I guess it's that skilled labour that they're very much after. So even though the labour market had been showing some signs of loosening in recent months, it's picked up. But I think there is still a challenge for some firms in some sectors to find quality labour that they need. It really varies across sectors. So some sectors are doing really well as a whole, particularly those that are invested in data centres or digital, whereas there's other businesses, particularly small-sized businesses in some sectors, that are doing it tough. It's really quite uneven, and I think as we move through the tightening cycle, we may see more of that unevenness, for want of a better description, move through. Mm-hmm. And that might also be reflected in the share market sectors.
So, Andrew, we're in this rising interest rate environment. Besa says 1, possibly 2 to come. So if I'm a growth investor, it actually means a lot. Like, it pulls a few different levers when it comes to growth investing.
Yeah, absolutely. And we sort of talked about in last episode the difference of the 3 main styles of value investing, the sort of deep value, Benjamin Graham style, last puff of the cigar, just look at the balance sheet. And for an investor like that, a changing interest rate really probably means nothing other than potentially more opportunities, because the change in interest rate will only really affect the balance sheet through the percentage of debt. And of course, if you're a Benjamin Graham style investor, you're already hoping that there's nothing there, so there's no debt to be affected. But for a growth investor, that second category that we spoke about is sort of the vast majority of value investors out there. Rising interest rates are one of the biggest inputs into your model, because they really affect your forecasts into the future in 2 really critical ways. The first, of course, is it impacts the time value of money. So that idea that $1 today is worth more than $1 tomorrow, the old saying, a bird in the hand is worth more than 2 in the bush. And when you're forecasting out to the future from a growth investor's point of view, you're going to try and bring all of those cash flows back to today to work out the net present value. What's it worth to you today? And the key impact or element that you're going to use in that is a discount rate, which includes as its core function underneath the risk-free rate. So as we change the risk-free rate up, so too should valuations across the board for a growth investor come down. And that's what you sort of see in the stock market, rising rates, falling stocks.
So that's the discount rate. What about its impact on growth?
Yeah, great question. So of course, then that's the other one we were talking about before around both business investment and consumer confidence. So the growth rate that you're going to be putting into your model, if you're a growth investor, is of course determined based on how much customers are going to buy your product and what they're prepared to pay for it. So in an environment where they have less money to spend, or they're feeling less confident about spending, you would expect that not only are you going to be discounting those cash flows at a greater rate, but there's going to be less cash flows. So you're going to get hammered in both the growth element and the discount rate. First example is, let's assume a company is worth $10 a share and it's trading at fair value. So it's worth about $10 a share. It's trading at $10 a share. There are 2 different scenarios that a rising interest rate, in theory across the board, is going to play out. The first is a company whose growth rate will be unaffected. What they're doing is not linked to interest rates in the economy, but they will still have a valuation impact because the discounted value of those future cash flows is now less. There's more opportunity cost associated. And we've got a question here where we said, well, if you just assume a company increasing its discount rate by 1%, which is a pretty small number in the scheme of things, it impacts in this scenario, and you could run it with different scenarios, the valuation of that company by as much as 11%, which of course is now quite a big swing. You know, imagine if the stocks you're invested in or the assets you're invested in overnight evaporated 11% of their value. That could be quite material for your portfolio. And on the other hand, if you take it even further and say not only is the discount rate going to be affected, but the growth is going to halve, in our example from 5% to 2.5%, then the impact for a growth investor is very material. We're talking here 25-30% reduction in the value of that asset. And that's sometimes why we see such huge swings on the stock market around interest rate expectations, because in the same way as a rising interest rate will hammer the value by a quarter, so too can a falling interest rate increase the value by a quarter. Of course, having said that, all of that's moot to a Buffett or Teaminvest style investor, because we're not really trying to look at the whole market and where that would go, but rather how a specific company will be affected.
So you're still looking at moats, low debt, all the usual stuff.
Yeah, I mean, the three real questions for a Buffett style or Teaminvest style value investor are just simply, is there something about the capital structure of this business that will be affected? Has changing interest rates made the business riskier or less risky? You know, if you're a lender, for example, it makes you less risky, right? The second question would be, has it affected your competitive advantage or your relationship with your customers or suppliers? And of course, if the answer to both of those two is no, then simply the only third question is, do I have a better use for my cash somewhere else, perhaps a term deposit now? And, you know, depending on those three answers, you'll get a different outcome for each company.
Besa, the other day I was speaking with another economist who said, it's inflation, it's inflation, it's inflation when it comes to the future path for the RBA. But ultimately, what is the Reserve Bank trying to do with interest rates, which we've been told over the years is a very blunt tool? You know, cool demand, obviously cool inflation. What else? I mean, do you think that it will be able to achieve slowing inflation, keeping the job market very full, and also not knocking growth on its head?
I mean, that's certainly what they're trying to do. They're trying to keep unemployment low, and the labour market robust, but at the same time they do need to bring underinflation down. They've actually got it going up to 3.7% in the year to June 2026. So that really suggests, I think, the size of the problem that they now face, that they do need to tighten the cash rate to try and bring that underlying inflation rate back in to that band. Now, their forecasts go out to 2028, and at no point does it get back into the middle of the band. The best it gets is 2.6%. So to us, that suggests there's more tightening that's needed, particularly in an environment where the labour market remains robust and there's evidence that employment activity has picked up. Housing is still robust, although that's likely to be tempered, but also just the fact that the potential growth rate in the economy is now lower. And so economic activity running a little bit above 2% is producing inflationary pressures, whereas, you know, a decade ago, that wouldn't have been the case because productivity was stronger.
Yeah, it's amazing. How conservative do you think investors should be right now? I mean, it's not just rates. You alluded to the geopolitics that are still out there right now. I mean, there are some pretty big risks in the macro environment. What are they to you?
Yeah, look, there are big risks, but and I think it just really underscores the fact that diversification is so important. And that means diversification across geographies. I mean, what we're seeing now is that emerging markets are picking up, Asian markets are picking up. In fact, in the year to last Friday, the strongest markets were the Hang Seng and the Japanese Nikkei. So it really speaks to the fact that you should be diversified across geographies, across sectors and across asset classes. And I think the speed in which the RBA changed the cycle really just highlights that if you're diversified, then you're better placed to manage those sorts of risks that can arise both domestically and offshore.
Besa Deda, William Buck, thank you so much for joining us. Andrew, hope you can stick around after the break when we will discuss what's in store for rate, how will it likely hit consumers and businesses, and therefore investors. Welcome back to Wealthy and Wise. Welcome back to Andrew Coleman from Teaminvest, and we're very pleased to welcome to the program Michael Carmody from Centennial Asset Management. Michael, nice to see you. Thank you so much for coming in. Just to set the scene again, how would you describe the type of investor you are? What do you follow a certain style?
So look, we are style neutral, if you want an official term. We've had a fund that's been in place for 13 years now. And look, we have designed the fund with a very flexible mandate. It runs money for individuals and small family offices and has no institutional money. But what we feel is very important is managing risk. And so at any particular time, we'll have 45 or 50 stocks, and the biggest position will be 5%, the smallest position will be sort of less than 1%. And look, we think it's very important through a cycle to protect capital. So occasionally we'll own large cap stocks. Most of the alpha over the 13 years of the fund has come from small cap names. That's sort of our specialty. But occasionally we think in times when markets are correcting, owning a significant portion of the fund in cash, which is probably your best asset class when markets are falling, it makes sense. And so we describe it as a very flexible mandate that gives you outperformance without the volatility that a pure market exposure would give you.
Okay, so that's interesting because we'll be able to do a little bit of a compare and contrast. But the previous conversation was all about if rates are going to continue to rise, which Besa, Deda, chief economist at William Buck, reckons they will once, at least twice. How should investors react first when rates rise?
Well, we think history's taught you that when rates rise, there are certain sectors that don't perform well. And so if you're an interest rate sensitive stock, a bank or a non-bank lender, where the cost of your funds is going up and arguably demand is going down because money's becoming more expensive, I don't think as an investor you want to be exposed to that sector during this phase when rates are arguably moving up.
So you want to maintain some sort of defensive-ness to protect that capital, as you said, was
Correct.
important, and you leave chasing opportunities to a little bit later once you've sort of built up the defenses?
Well, I think markets always give you opportunities. There's always stocks that you can own that probably do well regardless of what's happening with rates. But to answer the question on what's our immediate response to an increased rates environment is to exit those names that are sort of exposed to rates specifically. Like property trusts, for example, really have a consistent earnings number every year. The market prices them based on what the 10-year bond rate is or what the discount rate is. That's another sector that I don't think we want to have exposure to during this phase.
Andrew, we've talked about value metrics, including debt and moats. So does anything in that change, or do you go back to your portfolio, run the ruler over it again immediately when rates rise?
I think it depends on the kind of portfolio you're running. So, one of the questions that always has to be is how many stocks are in your portfolio and why are they there? So for example, if you're holding a broad portfolio with say a few opportunities, then there's more likelihood that a changing interest rates or changing anything, doesn't have to be interest rates, is going to affect something in your portfolio. So from that point of view, it's always good practice to go and have a look at what you own and see if the world as it is today is going to change your assumptions for the future. I think what's interesting though is if you have a portfolio that's relatively concentrated, so I'm talking sort of 20 to 30 companies, and you've picked those companies because you think that they will be net beneficiaries over the long term, so through one or more economic cycles, then the odds are that a rising or falling interest rate probably won't affect them very much. That's not to say that there won't be some effect, maybe to the share price, but overall the company itself should be one that you've already selected because it's not going to be exposed to rising rates. And we can talk about that a little bit later, but certainly some companies are much more vulnerable, and certain sectors of companies, to rising or falling rates than others. And depending on what's in your portfolio, that's therefore going to have a different impact.
And so you would also, as a general rule, avoid really heavily indebted companies. Is that right?
Yeah, I think, that's if a company has a balance sheet that's not strong, and a significant proportion of that is impacted by the increase in rates, profitability goes down. Normally share prices follow profitability. So a long-winded answer to your question, yes, I think that's right.
So we've got banks that are likely to be affected. We're talking sectors here, real estate trusts. That's an interesting one. Those companies that are heavily debt exposed. Would you avoid consumer-related companies as rates rise?
Yeah, I think we heard in the previous session that consumer confidence is probably softer than it would be. History tells you as rates go up, 65% of GDP in Australia is the consumer. Consumers tend to just push back a little bit on their demand. I think property prices reflect that as well. And so I think it's logical at this point in time to certainly avoid an overweight position in retail names.
You would like to discuss JB Hi-Fi. You sort of alluded to it in the previous segment. It depends, I guess, on the type of consumer because, arguably in a rising rate environment, there is a huge portion of the Aussie population, let's call them boomers, that might be doing quite well out of it.
Yeah, well, we talked about this last week, right? There's roughly a third of Australians that have a mortgage, a third of Australians that rent, and a third of Australians that own their own home or are living with someone that owns their own home. So from that point of view, 1/3 of our consumers are going to be net beneficiaries from a rise in interest rates. 2/3 are going to be net losers from a rise of interest rates. So the overall effect on aggregate demand is clearly going to be less demand. But the question is, not all companies have their customers in that same third, a third ratio. So we were talking a little bit before, but a really good example of seeing how this plays out, because we've just been through a rate rise and then a rate fall cycle, is to look at the earnings of two retailers. Now, why did I pick two retailers? Well, pretty simply, because I think in general, retailers are one of those more exposed to rising interest rates for the reasons we've just spoken about around people's consumer confidence.
Yeah, everybody, when the rates rise, say avoid retail stocks.
Exactly right. So if we just look at the retail sector, we just have to also accept that not all retailers are identical. They don't all sell the same product to the same people in the same demographics and geographies and all the rest of it. So two really interesting examples, because they're companies that most viewers here would probably know, are JB Hi-Fi and Cettire. Now, of course, JB Hi-Fi is selling technology-related, what I would almost argue are today's staples. In theory, they're consumer discretionary, but if your phone breaks or your laptop breaks, how long are you going to go before you replace that item? I think I've got about 10 minutes. That's the time it'll get me for an Uber from where I am currently to replacing my phone. So from that point of view, it's no surprise that when you look through the history of JB Hi-Fi through the last rate rise and fall cycle, you can barely see the impact in earnings. In fact, almost sales and earnings follow a very nice, simple trend line upwards, because effectively what they're selling is not rate sensitive, and the consumers who are purchasing are going to put some other purchase behind to conserve money before a replacement of a phone or a laptop. On the other hand, Cettire, of course, is an online retailer of luxury goods targeting particularly younger consumers, which is right smack in the sweet spot of who the RBA is hoping to crunch when we raise interest rates. And so when you look at Cettire's sales and earnings in relation to interest rate rises, you see huge swings, as you would expect. Rates rise, Cettire's sales collapse, rates fall, Cettire's sales rise. So as a value investor who's looking obviously at each company individually, you can have a very different view depending on which of those is in your portfolio as to the likely impact to you of an increase in interest rates or a fall in interest rates.
You'd agree that JB Hi-Fi is one of those more resilient sort of defensive companies?
Yeah. I certainly agree that from an earnings perspective, there's probably not a lot of material risk, but we're cognizant of the fact of how does the market price that earnings. And so, look, history's taught us that when rates go up, investors are less inclined to buy retail stocks. They tend to derate through this period, regardless of what earnings do in some circumstances. And so we think it's pragmatic to have an underweight position as far as retail is concerned at this phase.
And in the language we used last week, that would be, I think, Michael, to sort of put that in the terms we were using, that would be we expect sentiment or the PE ratio to contract rather than the earnings to contract. And I think that's an important point. When you look at price, it's really broken down into two metrics, of course. There's the underlying earnings of the company and the way the market views those earnings, the sentiment related. So while I'm talking about, and we're going to talk a lot about this program, the earnings part, the objective part, the sentiment part certainly plays an element in price, and it tends to oscillate around a long-term mean. We call that mean reversion in finance theory. So that idea that when interest rates rise, certain sectors fall out of love. When interest rates fall, they become in love, tech sectors, retail sectors as an example. And so over the long run, they will mean revert. They'll have a sinoid, a wave type curve around a long-term mean, which is roughly the market average. So you'll certainly get volatility, which can be your friend or your enemy, depending how you approach it.
Yeah, a lot of it comes down to timeframes as well. So, Michael, what sectors do you see as sort of more naturally defensive in this type of a rising rate environment?
Well, the example I'm going to give you, it doesn't specifically relate to the rate environment, but we have an overweight positioning in the mining services names at the moment. So commodities have run really hard in the last 12 months, gold particularly. the Australian miners have raised a lot of capital, and they're going to redeploy that capital into exploration activities and production activities. And so we've had a position in the likes of Monadelphous, like a Podium, ALQ, to give you a couple of examples. They're going to report fantastic results in the reporting season in February. You know, to some extent that's priced as far as valuations are concerned. And so you don't want to get too greedy with respect to, you know, holding those names, you know, when they get to really lofty multiples. But we've still got those positions in the portfolio because we think there's some value to be discovered still from the market.
How do you think about valuations when we talk about high valuations that you just alluded to?
Oh, look, we're no different from most fundamental investors. You know, free cash flow is very important to us. A strong balance sheet's important to us. And we look at the growth that a particular company will deliver relative to the market and its multiple relative to the market. So if we take a mining services company, they're not brilliant companies. Their barriers to entry aren't necessarily high. At different points in the cycle, that there's earnings volatility. Monadelphous is a wonderful company. It's run really well, but it's trading in the high 20s now as far as multiple is concerned versus a market that's trading considerably below that. That's expensive, right? But they won several big contracts recently. We still think they're in an earnings upgrade mode, and so we're happy to hold the stock with that background.
What about healthcare as a sector when rates are rising?
Well, I think healthcare is traditionally a good defensive sector. Obviously, most healthcare in this country is funded by the federal government, and those funding mechanisms don't change in a rising rate environment. So, you know, a radiology company like IDX, for example, is well positioned to continue to deliver you consistent earnings, I think, through an interest rate increasing environment. And that's one of the healthcare names we have in the portfolio.
Mm-hmm. Do you have exposure to healthcare, and would you consider that to be relatively defensive through this type of environment?
Well, I think we get sick regardless of what the interest rate is, right? So, and thankfully in this country, we don't get bankrupted by those medical bills. So a rising interest rate doesn't affect our propensity to consume healthcare. So I agree with that point from Michael. I think what's interesting again is if you look at the healthcare sector, not all healthcare companies are created equally. So they won't all be affected the same way. Now, I think it's true to say that pretty much all healthcare companies are unlikely to have much in the way of their demand, their consumer demand affected by interest rates. So in that sense, it's defensive. But they all have different capital structures, how they've been funded. And so a company, for example, like Ramsay Healthcare, with very high debt, is likely to get hurt in a high interest rate environment, even though there'll be no fewer patients walking through the doors of a Ramsay hospital. And on the other hand, CSL as an example, which has much lower debt, highly unlikely to be affected because your need for blood plasma, your need for iron deficiency treatment, and outside of the United States, your need for virology services is unaffected by the interest rates, regardless of what perhaps certain politicians in the US might think.
We'll leave that one there. Let's get to, and I'm just going to sneak this in because oftentimes when we're talking about rising rates, particularly in the small end of the market, we sort of see tech as the whipping boy.
Yeah.
You know, when you come to discount rates going forward. Or, Michael, are you seeing opportunities in some of the sell-off that we've seen lately? Do you differentiate between tech and software now in the advent of AI?
Well, I think AI has driven the dramatic fall in software stocks, both in the United States and here. I don't think we can blame the RBA for that circumstance. And absolutely, there's opportunities. There are some wonderful companies that have business models that the market has decided to discount very heavily. I mean, the market does shoot first and ask questions later, and we're in that phase where they're getting shot at the moment. And we look at the price corrections that have taken place that are in the sort of 50 to 60% range for Xero and REA and WiseTech and a long list of names. The insurance brokers are getting belted today for not by the same order of magnitude, but for similar reasons. And so absolutely there's opportunities there. If we go back to the .com boom, you know, Google wasn't even listed when we were all making decisions on who the winners and the losers were going to be. I don't think we know the answers yet. We certainly don't. But there's certainly opportunities for stocks that have derated quite materially in the current environment.
Do you think it's fair that REA has been derated so materially?
Look, you know, if fair is a funny word to use, you know, like I think people are looking to take strategy decisions associated with risks. And markets always misprice equities. Whether it's cheap or expensive at the moment, I think it's hard to tell. I suspect it's cheap, but we haven't bought the stock yet. We haven't fallen on a decision there yet. Is it fair? Well, probably not, but the reality is that's what markets do.
Yeah, well, that's an interesting one, isn't it? REA, quality company in your view, Andrew?
Oh, absolutely. The interesting question you mentioned, is it fair? I think it was fair because the PE got astronomical, as many of the tech stocks did, more so than the fall has been unfair. But to your point before, if we take it back to the interest rate environment, I think what's really interesting, if we want to look at tech stocks, is let's compare two tech stocks that are not only both tech, but are in effectively the same sector, which is online classifieds, which in this case we can use as REA Group because it came up, so selling homes, and Seek, selling employment. And I've chosen those two, and you'll see them on the chart because, of course, interest rates affect them very differently. What's really fascinating is you would think that interest rates would affect REA really strongly. You know, the price of homes is certainly very clearly linked, and the price of commercial real estate is clearly linked to interest rates. But remember that REA charges per listing. And there are just as many people wanting to buy or sell a home, whether rates are high or rates are low. The difference is the price they transact for. And so when you look at REA's earnings over time, you see almost no correlation with interest rates. The earnings continue to rise sort of regardless of what the interest rate cycle is doing. On the other hand, if you look at Seek, which is also an online classifieds business, it's charging based on its ability to place people in a job. And clearly, therefore, because it's not charging the job seeker, it's charging the job poster. When there are less jobs in the economy, so too does Seek's earnings fall. And so what's really interesting is here are two online classified businesses exposed to the same thing, but because of how they price it with their customers, get very different effect on earnings. So REA charges you to list your home whether your home sells or not, and regardless of your reason for selling your home. And if you ever put your house on REA, you know they charge you whether someone ends up taking it off your hands or not. On the other hand, with Seek, of course, they're only charging one side of that equation, the business posting the ad. And if there are less jobs being posted, Seek's earnings will collapse accordingly. And so Seek is very volatile with interest rates. And I think that's the question that a Buffett or a Teaminvest style investor always has to go through. We know that aggregate demand will drop when interest rates rise. We know certain sectors will be affected more than others, and we know sentiment will change. But that matters not a bit if your portfolio is constructed differently. Not because there isn't an impact, but the impact's different depending on entirely what's in your portfolio. So you really need to want to understand your companies really well so that through the cycle you can buy wonderful businesses at reasonable prices and know that changes that are out of your control are unlikely to affect your long-term net wealth, even if they might have a short-term impact.
What do you tell investors when things are volatile like this and there's some unknowns, particularly when it comes to the economic outlook?
Look, I mean, we sort of spoke with our feet. Like, we've sold our banks, we've sold our non-bank lenders, we've sold our consumer-facing stocks because we think they're likely to underperform. And so, if someone asks me why we've done that, we've kind of been through chapter and verse why we think that they're likely to be underperformers during this interest rate increasing cycle, whether we get one or two from here. We think that on the other side, you know, for that money that you have invested in markets, you know, those defensive names make sense. And then there's always opportunities, you know, in the data center space. We own a stock called SKS. You know, that's an entity that provides contractual electrical services to that industry. And that still looks like it's upgrading earnings. And so we say there's always opportunities to deploy capital in sectors where, you know, there is growth. And the electrification that's taking place in this country at the moment. We own another stock called Genus Plus. You know, they're contractors that are leveraged to big contracts that are being deployed in Australia to position us to take energy from untraditional sources or non-traditional sources, you know, to capital cities. And so we think there are opportunities to deploy capital still.
Well, thank you, Michael. Thank you, Andrew. We'll take a short break and then we'll get to our viewer question. Well, let's get to today's question from our viewer, Peter, who says that he enjoyed the show last week and that he enjoys the content as well. So thank you for that, Peter. He says, what do you think of dollar cost averaging? For example, after doing analysis and deciding a stock is worth buying, is it a good idea to dollar cost average, or he says average down as some call it, assuming all of the metrics are the same or improved since your initial or previous purchase? Peter, thanks for the question. Let's turn to our guests. Michael, I'll start with you. This one?
So, look, we think dollar cost averaging makes a lot of sense, but averaging down doesn't, in our view, right? So I just want to differentiate between the two. So if you've decided that you can see a stock has value and you want to own that stock, I think if you buy the first third in month 1, the second in month 2, and the third in month 3, then if the stock rallies hard, you get some of the advantage of that. If the stock doesn't rally, you certainly haven't put all of your investment in on that one day. So we think that makes sense. I just don't want to confuse that with averaging down. To be honest, that's not a skill that I'm particularly good at. I think sometimes the market does know a lot more than we know. And for example, if you buy a stock and it promptly falls 10%, someone knows something. Markets are normally pretty efficient in the long run. And I think a stop loss in that circumstance to allow you to exit that stock, then to take some time to reassess the thesis on that stock, to discover what might or might not be wrong, and the capacity to re-enter it in time probably makes more sense than averaging down into that stock while it's falling.
Okay, so there's one view. Agree?
Not parts yes, parts no. So I absolutely agree with Michael's point of separating dollar cost averaging from averaging down. So I think it's worth maybe just defining those two just to make sure that all of us are on the same page. So dollar cost averaging is simply an approach where you take the fixed amount of money you have to invest and spread it out over time so you don't get hit by any sudden changes in movements of the share price. So effectively averages the cost over, say, a 3 or 6 month period for you. And that's an effective strategy if what you're concerned about is market pricing risk or short-term volatility. So from that point of view, it's a very logical strategy. I've no objection to it. I think the separate question there, which Peter's asking, is using dollar cost averaging not to spread your risk over time, but as a way of increasing your holding of a company you like. And my question to that would be, why use dollar cost averaging? Why not just buy more of the thing you like? So what I mean by that is if company A is a wonderful company and you think it remains a wonderful company and it's now on sale, why not buy more of it? On the other hand, if it was a wonderful company and the price has gone up such that you're no longer prepared to pay for it, well, then, of course, hold what you've got or think of selling, don't buy more of it. So I think sometimes we overthink financial concepts. If you think of it as just simply as buying a stock, owning a piece of a business, or a similar kind of decision like going into a store and buying a t-shirt. So you can choose to buy your t-shirt at any time in the year, unless you really need a t-shirt today, you left yours at home in the gym bag. So provided you've got the luxury of waiting for time, you would wait, I would think logically, until that t-shirt is on sale, which means in a market sense, when that share price has fallen and you don't think that that fall is related to the quality of the asset. So the t-shirt's the same t-shirt, it's just cheaper. The challenge, of course, is A, waiting, that requires patience, and B, being certain that that t-shirt's the same t-shirt, because it could have fallen in price because someone took a knife to it. It's got a big slash sitting through it. So you've got to be certain of that. So Peter, if your question is, if I'm still certain the company is wonderful, all the metrics look the same, the moats are just as good, it remains a valuable thing for me to own, then buying more when it's on sale, great idea. I just wouldn't confuse it with the concept of dollar cost average.
Well, it's funny you say that about complicating things, because my last question was, can sometimes investors just complicate things a little bit too much?
Oh, I guess so, but investing is not a trivial occupation, and it's important to, I think, take it seriously. And look, I would say it is complicated. I mean, we're there every day and we get it wrong quite considerable numbers of periods of time. Like I think it's a serious business and it's people's financial futures. So we might overcomplicate it, but I think it's wrong to simplify it, I suppose.
Got it. We'll have to leave it there. Michael Carmody from Centennial Asset Management, thank you for your insights. And you too, Andrew Coleman from Teaminvest. Lovely to have you here. That is Wealthy and Wise for this week. You can catch up online at ausbiz.com.au, and we'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.